Have you ever entered a trade because RSI said oversold, only to watch price keep falling? Or bought a breakout above the Bollinger Band just to get stopped out moments later? Here's the truth. No single indicator works all the time. RSI gives false overbought or oversold readings in strong trends. Bollinger Band breakouts can occur with little follow-through. ADX can lag early in a trend. Today I'm going to show you how to combine 5 powerful indicators: Bollinger Bands, RSI, ADX, ATR, and Volume, into a single Confluence trading system. This isn't about adding more lines to your chart. It's about building a filtering system that only fires when multiple independent conditions agree. By the end of this masterclass, you'll know exactly what each indicator tells you and what it doesn't, how to combine them into a complete trading system, entry rules, exit rules, and volatility-adjusted risk management, how to backtest and optimize the strategy. Part 1. Understanding the 5 indicators. Let's start with the foundation, understanding what each of these indicators actually measures. Because if you don't know what they're telling you, you're just guessing. 1. Bollinger Bands, the volatility envelope. Bollinger Bands consist of a middle band, a 20-period simple moving average, with upper and lower bands placed 2 standard deviations away. They measure 2 things: volatility, the width of the bands, and statistical extremes, when price touches or breaks the outer bands. When price hits the upper band, it's statistically overextended to the upside. When it hits the lower band, it's overextended to the downside. But here's the key. Bollinger Bands don't predict direction. They just tell you where price is relative to its normal range. Think of them as a volatility envelope. When the bands squeeze, contract, it signals low volatility and often precedes a breakout. When they expand, volatility is increasing. 2. RSI, the momentum oscillator. RSI, Relative Strength Index, is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100. Traditional levels. Above 70 is overbought, below 30 is oversold. But here's the mistake most traders make. In a strong uptrend, RSI can stay above 70 for weeks. In a strong downtrend, it can stay below 30. RSI doesn't mean reversal, it means momentum extreme. That's why we need other indicators to confirm. The real power of RSI comes from divergence, when price makes a new high, but RSI makes a lower high, or price makes a new low, but RSI makes a higher low. That's a warning sign that momentum is weakening. 3. ADX, the trend strength filter. ADX, Average Directional Index, measures the strength of a trend, not the direction. Developed by J. Wells Wilder, ADX tells you whether the market is trending or ranging. Wilder's guidelines. ADX below 20 means no trend. The market is ranging or choppy. ADX above 25 means a strong trend is present. ADX above 40 signals a very strong trend. The ADX is your market regime filter. If ADX is below 20, you shouldn't be trading trend-following strategies. You should be looking for mean reversion setups. If ADX is above 25, trend-following strategies become viable. ADX also includes the plus DI and minus DI lines, which show directional bias. When plus DI crosses above minus DI, bullish momentum is strengthening. When minus DI crosses above plus DI, bearish momentum is strengthening. 4. ATR, the volatility yardstick. ATR, Average True Range, measures market volatility by calculating the average range of price movement over a specific period. It's expressed as a dollar or point amount. Higher ATR equals higher volatility. Lower ATR equals lower volatility. ATR doesn't tell you direction, it tells you how much the market is moving. ATR is probably the most underrated risk management tool in trading. Why? Because it lets you set volatility-adjusted stops and targets. If volatility is high, your stop needs to be wider. If volatility is low, you can use tighter stops. Simple, but most traders ignore it. Combine ATR with ADX and you get something powerful, the ADX-filtered ATR. This separates meaningful volatility expansion, where volatility grows in the direction of a strengthening trend, from choppy noise where volatility rises without direction. 5. Volume, the conviction meter. Volume is the fuel behind price movement. It tells you if there's real conviction behind a move or if it's happening on weak participation. John Murphy's rule. Volume should confirm price. A breakout with high volume is much more reliable than a breakout with low volume. Low volume breakouts are often fakeouts. In our strategy, we compare current volume to a moving average. We typically want volume to be above 1.5 times the average for breakout confirmation. Some traders use 2 times the average for higher conviction. Part 2. The Confluence Strategy. Putting it all together. Now here's where it gets interesting. We're not using these indicators in isolation. We're building a confluence system where multiple indicators must agree before we trade. Think of it like airport security. Each indicator is a checkpoint. Your trade idea has to pass through all 5 checkpoints before it gets the green light. If any filter fails, no trade. The 5-step filter system. Filter 1. Market regime, ADX. We start by asking, is the market trending or ranging? ADX 25. The market is trending. We look for breakout or pullback trades in the direction of the trend. Filter 2. Volatility context, Bollinger Bands. Where is price relative to its normal volatility range? In ranging markets, ADX 25, we want price breaking through the bands with momentum. This signals volatility expansion. Filter 3. Momentum confirmation, RSI. Is momentum aligned with our trade direction? For long trades, RSI should be above 50 in a trending market, shows bullish momentum, or below 30 and reversing in a ranging market, oversold bounce. For short trades, RSI should be below 50 in a trending market, or above 70 and reversing in a ranging market. We also look for RSI divergence. If price makes a lower low but RSI makes a higher low, that's a powerful bullish reversal signal. Filter 4. Volume confirmation. Is there real conviction behind this move? For every trade signal, we require volume above the 20-period average. For breakout trades, we want volume at least 1.5 times the average. Low volume equals low conviction equals no trade. Filter 5. Risk management, ATR. Can we manage this trade properly? We use ATR to calculate dynamic stop loss and take profit levels. If the ATR-based stop is too wide for our risk tolerance, we skip the trade. Risk management isn't an afterthought. It's a filter that determines whether a trade is even worth taking. Part 3. Entry and exit rules. Now let's get into the specific entry and exit rules. Remember, these are guidelines. You'll need to backtest and adjust based on your market and time frame. Scenario A. Ranging market, ADX 20. Mean reversion. When ADX is below 20, the market has no strong directional bias. Price tends to oscillate around the mean. This is where mean reversion strategies work best. Long entry, buy. 1. Price touches or breaks below the lower Bollinger Band. 2. RSI is below 30, oversold, or showing bullish divergence. 3. Volume is above average on the reversal candle. 4. ADX is below 20, confirming ranging market. 5. Risk to reward ratio is at least 1 to 2. Short entry, sell. 1. Price touches or breaks above the upper Bollinger Band. 2. RSI is above 70, overbought, or showing bearish divergence. 3. Volume is above average on the reversal candle. 4. ADX is below 20. 5. Risk to reward ratio is at least 1 to 2. Scenario B, trending market, ADX 25. Trend following. When ADX is above 25, the market has strong directional momentum. We want to follow the trend. Long entry, buy. 1. Price breaks above the upper Bollinger Band with momentum. 2. RSI is above 50, confirming bullish momentum. 3. Volume is at least 1.5 times average, strong conviction. 4. ADX is above 25 and rising. 5. Plus DI is above minus DI, bullish directional bias. Short entry, sell. 1. Price breaks below the lower Bollinger Band with momentum. 2. RSI is below 50, confirming bearish momentum. 3. Volume is at least 1.5 times average. 4. ADX is above 25 and rising. 5. Minus DI is above plus DI, bearish directional bias. Scenario C, the squeeze setup. One of the most powerful setups is the Bollinger Band squeeze. When the bands contract significantly, bandwidth below 75% of its 50-period average, it signals that volatility is compressed and a breakout is imminent. When you see a squeeze, wait for the breakout direction. Break above upper band with strong volume and RSI 50 to long. Break below lower band with strong volume and RSI 40. Exit rules. Now, exits. This is where most traders struggle. Here's our 3-tier exit system. 1. Stop loss, ATR-based. Set stop loss at 1.5 times to 2 times ATR from entry. This gives the trade breathing room based on current volatility. In high volatility, stops are wider. In low volatility, stops are tighter. 2. Take profit, risk-reward based. Minimum 1 to 2 risk-reward ratio. In strong trends, ADX 40, consider 1 to 3 or higher. Some traders use 2 times ATR for take profit. 3. Trailing stop, lock in profits. Once price moves 1 ATR in your favor, activate a trailing stop. Trail at 1 ATR distance to protect profits while letting winners run. In strong trends, this can turn many would-be losses into break-even or small wins. Additional exit triggers. ADX falling below 20 trend is weakening. Consider exiting. Price reverting to the middle Bollinger Band. Mean reversion target hit. RSI divergence against your position momentum is reversing. Part 4. Market Regime Detection. This is the secret sauce, adapting your strategy to market conditions. You don't trade a ranging market the same way you trade a trending market. The combination of ADX and ATR helps you identify which regime you're in. The 4 market regimes. Regime 1. Trending plus high volatility, green. ADX 25, ATR above historical average. Strong directional momentum with expanded range. Best 4. Trend following breakouts, wider stops. Avoid. Mean reversion, tight stops. Regime 2. Trending plus low volatility, blue. ADX 25, ATR below historical average. Steady trend with compressed range. Best 4. Pullback entries, momentum continuation. Avoid. Breakout chasing, low volatility equals low momentum. Regime 3. Ranging plus high volatility, red. ADX 25, ATR above historical average. No direction but wide price swings, choppy. Best 4. Mean reversion at Bollinger extremes, scalp trades. Avoid. Trend following, holding positions. Regime 4. Ranging plus low volatility, gray. ADX 25, ATR below historical average. Consolidation, low activity. Best 4. Waiting, no trades, or preparing for squeeze. Avoid. Almost everything. Low volatility equals low opportunity. This regime detection is your macro filter. Before you even look for a trade, check which regime you're in. If you're in the wrong regime for your strategy, don't trade. Part 5. Step-by-step trading examples. Let's walk through real trading examples so you can see how all 5 indicators work together in practice. Example 1. Bullish trend following trade. Setup. ADX is 32, strong trend. DI plus is above DI minus, bullish bias. Price breaks above the upper Bollinger Band with a strong bullish candle. RSI is 62, above 50, confirming bullish momentum. Volume is 1.8 times the average, strong conviction. ATR is expanding, volatility supporting the move. Entry, buy at the close of the breakout candle. Stop loss, 1.5 times ATR below entry. Take profit, 3 times ATR above entry. Trailing stop, activate at 1 ATR profit, trail at 1 ATR. Result, price continues trending, trailing stop locks in profits, trade hits take profit. Example 2, bearish mean reversion trade. Setup. ADX is 18, ranging market. Price touches above the upper Bollinger Band, statistically overextended. RSI is 74, overbought, showing bearish divergence. Volume on the reversal candle is above average, sellers stepping in. ATR is average, normal volatility. Entry, sell at the close of the bearish reversal candle. Stop loss, 1.5 times ATR above entry. Take profit, middle Bollinger Band, mean reversion target. Alternative TP, 2 times ATR below entry. Result, Price reverts to the mean. Hits take profit at the middle band. Example 3. The squeeze breakout. Setup. Bollinger bandwidth has contracted to below 75% of its 50-period average. Squeeze. ADX is 22 and rising. Trend is establishing. Price breaks above the upper Bollinger Band with a large bullish candle. RSI jumps from 48 to 65, momentum accelerating. Volume is 2.2 times average. Explosive conviction. ATR is expanding rapidly. Volatility breakout. Entry, buy at breakout. Stop loss, 2 times ATR below entry, wider due to volatility expansion. Take profit, 3.5 times ATR above entry. Trailing stop, activate at 1.5 ATR profit. Result, explosive move, trailing stop captures the bulk of the trend. Part 6. Backtesting and optimization. This strategy isn't a set-it-and-forget-it system. You need to backtest and optimize for your specific market and time frame. What to backtest? 1. Different ADX thresholds. Try ADX 20 versus ADX 25 versus ADX 30. Find the threshold that best filters out chop in your market. Some traders use dynamic thresholds based on the rolling mean of ADX. 2. Different ATR multipliers. Test stop loss at 1 times, 1.5 times, 2 times, and 2.5 times ATR. Test take profit at 2 times, 3 times, 4 times, and 5 times ATR. Find the balance between giving trades room and protecting capital. 3. Different volume filters. Test 1.2 times, 1.5 times, 2 times, and 2.5 times average volume. Higher filters equals fewer trades but higher conviction. Lower filters equals more trades but more false signals. 4. Different Bollinger Band settings. Default, 20 period, 2 standard deviations. Try 20, 1.5 or 20, 2.5 or 14, 2. Adjust based on the volatility characteristics of your instrument. 5. Different time frames. Test on 5-minute, 15-minute, 1-hour, 4-hour, and daily. The strategy works differently on different time frames. Find the time frame that best matches your trading style. Optimization pitfalls to avoid. Curve fitting. Don't over-optimize for historical data. The goal is robust performance, not perfect backtest results. Survivorship bias. Test on multiple instruments, not just the one that worked. Slippage and commissions. Factor these into your backtest. Real-world execution is never as clean as backtests suggest. Part 7. Risk management and position sizing. Even the best strategy will lose money without proper risk management. Here's how to protect your capital. Position sizing with ATR. Use ATR to size your positions. Position size equals account risk into account size, or ATR into stop multiplier. Example, account, $10,000. Risk per trade, 2%, $200. ATR, 100 points. Stop multiplier, 1.5 times ATR equals 150 points. Position size equals $200, or 150 equals 1.33 units per point. This ensures you risk the same dollar amount on every trade, regardless of volatility. When volatility is high, you trade smaller. When volatility is low, you trade larger. The 1 to 2% rule. Never risk more than 1 to 2% of your account on any single trade, period. This isn't a suggestion, it's survival. If you risk 5% per trade, 5 losing trades in a row wipes out 25% of your account. If you risk 2%, 5 losses wipe out 10%. Preserve your capital. The trailing stop advantage. The trailing stop is where this strategy really shines. Here's why. Most traders get stopped out at break-even or take small profits, then watch the market run without them. The ATR-based trailing stop lets winners run while protecting profits. Example, you enter a trade with a 2 times ATR stop. Price moves 1 ATR in your favor. You activate the trailing stop at 1 ATR. Even if price reverses hard, you break even or take a small profit. But if the trend continues, you capture the entire move. Part 8. Common mistakes to avoid. Let's talk about the mistakes I see traders make with this strategy, so you don't make them. Mistake number 1. Forcing trades when ADX is below 20. But the setup looks good. No, if there's no trend, trend following doesn't work. Wait. Mistake number 2, ignoring volume. The breakout looks clean. Without volume, it's probably a fakeout. Volume is non-negotiable. Mistake number 3, using fixed stop-loss levels instead of ATR. I always use a 20 pip stop. That doesn't account for volatility. In high volatility, 20 pips gets hit instantly. In low volatility, it's too tight. Mistake number 4, taking every signal. Just because a signal fires doesn't mean you have to take it. Quality over quantity. Mistake number 5, not adjusting for market regime. Using the same strategy in trending and ranging markets. The regime detection isn't optional, it's essential. Mistake number 6, over-optimizing. Chasing the perfect settings for historical data. Robustness matters more than perfection. Part 9, recommended settings and timeframes. Here are my recommended starting settings. Remember, these are starting points, not absolute rules. Default settings. Bollinger Bands, length 20, standard deviation 2.0. RSI, length 14. ADX, length 14, threshold 25. ATR, length 14. Volume, 20 period moving average, 1.5 times filter. Time frame recommendations. Scalping, 1 to 5 minute. Faster settings, ADX 14, tighter bands. Higher volume thresholds to filter noise. Quick exits, tighter stops. Day trading, 15 minute to 1 hour. Standard settings work well. Good balance of signals and noise reduction. Most active traders' sweet spot. Swing trading, 4 hour to daily. Standard or slightly longer settings. Wider stops, 2 times ATR, for more breathing room. Higher conviction trades, fewer signals. Crypto versus stocks versus Forex. Crypto, BTC, ETH. Standard settings on 1 hour or 4 hours. Stocks, standard settings on daily. Forex, may need adjusted ADX thresholds due to different volatility patterns. Conclusion and final thoughts. Let's recap what we've covered today. The 5 indicators. Bollinger Bands equals volatility envelope and statistical extremes. RSI equals momentum and divergence. ADX equals trend strength and market regime. ATR equals volatility-based risk management. Volume equals conviction confirmation. The strategy. ADX determines market regime, trending versus ranging. Bollinger Bands identify entry zones, extremes or breakouts. RSI confirms momentum alignment. Volume confirms conviction. ATR sets dynamic stops and targets. Risk management. 1 to 2% risk per trade. ATR-based position sizing. ATR-based stop loss and take profit. Trailing stop to protect profits. Here's the thing about this strategy. It's not magic. It's a systematic approach to trading that forces you to think about market conditions, conviction, and risk management before you enter a trade. It won't win every trade. No strategy does. But by requiring confluence, multiple indicators agreeing, you dramatically reduce false signals. And by using ATR-based risk management, you ensure that your losses are controlled and your winners can run. Your homework. 1. Add these 5 indicators to your charts. 2. Paper trade for at least 20 to 30 signals before using real money. 3. Backtest different settings for your specific market. 4. Keep a trading journal. Track every signal, win or lose. If you found this masterclass valuable, please like, subscribe, and hit the notification bell. Drop a comment below. What market do you trade and what time frame? I'd love to hear from you. Until next time, trade smart, manage your risk, and remember, Confluence is king.